Hey guys, it's Sunmin and welcome back to Your Money Game, the show where we'll get better with saving, spending, and today we're diving right back into the exciting world of ETFs. So last week, I started with an introduction to the exciting world of exchange traded funds or ETFs. This week, I continue the conversation with a little bit more of a deeper dive into one of the key questions. How do ETFs stack up against popular unit trusts, or in other places, people know them as mutual funds? I'll start with a quick overview and then I'll dive into the thick of it by doing a side-by-side comparison across the two, and then finally cap it off with a little bit of considerations that we need to have should we be considering either of those two things. So my first encounter with unit trusts actually began sometime probably in my late teens or early 20s. My parents were telling me the story of how they invested in a unit trust, and unfortunately, thanks to the 1997 Asian financial crisis, it crashed and they lost a lot of money. And that really left a really bad taste in their mouth. Fast forward a few years, and as soon as I was working, I began learning about the stock market, and then it became a default choice. It's either you choose to invest or trade in stocks, or you buy unit trusts. It just simply became the default, I think, for a lot of people in this region. So you might ask why? Why are unit trusts so widespread in Singapore and Malaysia? So let's dive really quickly into that. So the first mutual fund was actually introduced by a Dutch merchant back in 1774. What he wanted to do is gather a pool of assets for investment purposes, and that's exactly what a fund is. So throughout the centuries after, there have been variations, but fast forward to 1924, which is when you see the first modern day mutual fund introduced in Boston. Fast forward a few decades, and within this region, Malaysia introduced the unit trust back in 1959. When a product like unit trusts are recognized by banks as well as financial advisors, and then you have agents that introduce it to us as a really good financial vehicle to invest in. ETFs, on the other hand, are relatively new, and on top of that, they're not really sold by any agent or any bank. And unfortunately, if you look at the stock exchanges in Malaysia and Singapore, you just don't see as many ETFs listed. So enough history, how do unit trusts and ETFs compare? Let's start by tackling the biggest elephant in the room, which are costs and fees. And if you've ever read a comparison between the two, you will definitely have seen this being brought up, and it's brought up for a very good reason. With unit trusts, unfortunately, you've got so many different types of fees. You've got the sales fee, you've got the switching fee if you want to switch between funds, and then you have the annual management fee, and then you have the exit fee as well. But actually, what really makes me uncomfortable is how untransparent a lot of these things are. Unless you're using an agent which can explain things very clearly to you, if you were to dive into the fund prospectus, oftentimes they tend to list figures that are up to a certain amount, but they don't tell you exactly what is it that you'll be paying. Unfortunately, the ETFs in Malaysia and Singapore sometimes still do try and bury a lot of that information. But if you're looking at any ETFs in the US, any screener, any type of popular platform will tell you very quickly what is the expense ratio. Of course, not forgetting, because they are exchange traded, what happens is if you're using a broker, they're gonna charge you a fee for the transaction anyway. But increasingly, where the world is going now is to allow free commissions, so it might be something that you don't have to put up with for a very long time more. In the vast majority of times, you'll find that ETFs have an expense ratio that is much cheaper than the majority of unit trusts. And oftentimes, you'll be able to find an alternative ETF which is very similar to a unit trust that you might like for a much cheaper cost. The one exception of unit trust that I've managed to find is Dimensional Fund Advisors, and these guys issue unit trusts that are much more cost effective, but they are only available in Singapore and through a registered agent. Unfortunately, they're not available in Malaysia. But one piece of good news, should you be interested in it, is that towards the later part of this year, they've already announced plans to introduce their own ETFs. Now, one common thing that I keep hearing from people is they say that, hey, it's okay if I pay a higher fee for unit trust because last year the performance was really good. Unfortunately, research shows that fund managers on the majority do not outperform the benchmark indexes. So it really becomes a question of, can you really pick a fund manager that vastly outperforms the majority of them. And on top of that, one thing is for certain is that high fees have a very high correlation with poor performance over the long run. Another final smaller problem in the cost area is that unit trusts tend to cost more to start. They usually have a minimum start fee of about $1,000, and on top of that, a minimum top-up fee of at least $100 moving forward. So in the cost dimension, ETFs are a very clear winner. The next dimension is variety and selection. So if you read a lot of the older articles, they would usually say that ETFs are usually known as passive investments, while unit trusts tend to be known as active management. But increasingly, there are many more actively managed ETFs that are being introduced into the market, such as the one that I talked about in my last video, ARKK. And again, unfortunately, in the Singapore Stock Exchange as well as the Bursa, we don't really have a lot of actively managed ETF options at this point. So the win here currently goes to unit trusts, but for practical reasons, and if you were interested in the US markets, ETFs there really do give you an equal amount of practical options depending on what kind of investment strategy you were interested in. Another practical thing that's demanded by the gods of YouTube is for you to click that like and click that subscribe button. The next big dimension is ease, and there are a few factors here. In terms of the ease to start, I give this win to unit trusts. The reason why is that unit trusts tend to be sold to you by either a bank or a financial advisor. Having a familiar figure, whether it's your bank, whether it's your advisor, providing a very easy document for you to just sign right here, it's easy to start. And that brings us to the ease of choice. And in this case, both can honestly be equally complex. If you're new to it, you're looking at the literally thousands of available funds, you can get a bit confused, but there is a slight edge here that I'll give towards unit trusts simply because they tend to be sold to you. The next type of ease is the ease of moving your money, and ETFs here have the clear edge. If you were interested in getting in and out of an ETF, you can buy and sell them all day long during trading hours. Any withdrawal of funds are really just at the speed of the broker that you're using. For unit trusts, unfortunately, it can take a little bit longer, up to a few days even, for you to get out of a unit trust position or even make switches. Now, the final factor that I want to talk about is often overlooked, and this one is a winner for unit trusts. And this factor is called consistency. Unit trusts tend to be sold to you, again, either by an agent or a bank. And during that process, it's very easy for you to set up a recurring kind of payment system. So that way, it ensures that you as an investor take the most important step, which is building a consistent habit. And when it comes to ETFs, the power and responsibility falls 100% on your shoulders because it's up to you to build that consistent habit. And this brings us into the last section, which is considerations that you need to think about as you're evaluating them. Are you confident of your ability to consistently execute your investment plan? If you're not, unit trusts might have that advantage. Next, if you're interested in a unit trust or a very specific strategy, always keep an eye out for alternative ETFs. This is good practice even evaluating between ETFs. Thirdly, if you're interested in a very specific fund manager because you like their strategy, you like their story, how confident are you in them? This really applies to actively managed funds, both in unit trusts as well as ETFs. The last consideration is that if you have a financially complex life and you require an advisor, on top of that, if you want somebody to provide that assurance to put together that portfolio for you, unit trusts might be the vehicle that they use to execute that investment strategy. So I've done my best to provide a fairly impartial view of both ETFs as well as unit trusts. But on a personal note, before I go, I'm definitely biased towards ETFs. And it's not just because of the cost, which is a major factor, but it's also the fact that I have my own investment strategy put in place. But I would like to reassure you that it really isn't as difficult as it looks. And on top of that, it's a skill that once you develop it, it's gonna last you a lifetime. So with that said, if you have any questions at all, feel free to leave it down below in the comments, and I hope you really got a lot of value out of this video. If you did, I would really appreciate it if you hit that like, subscribe, as well as that bell button, because I'm gonna be back again next Sunday with a brand new video. And until then, take care, and keep playing your own game.